Okay, this is a short video going through the answers in the Module 2, Chapter 2 in class and group problems. We didn't have a chance to finish them up and look at all the answers, so I went ahead and decided to make a little video regarding some of the stuff we didn't get to. This is the stuff we did during class, and here is an answer key for you. I will scan this and put it up to the class. But I also just wanted to have this for you so that you could look at it and check over your work and see the thought behind it in case you didn't get to take accurate notes during class. And so that is the adjustments. And then I went ahead and just did all of the closing entries, even though I only asked for the two that affected retained earnings. But I went ahead and did the revenue and expense closing entries just so you could see them, and the T accounts for income summary and retained earnings. All right, so that was the first one. We didn't get to finish in class the adjusting entry error problem, and I wanted to go over it especially because the second year is a tricky year. A lot of people tend to get this second year wrong because they don't quite understand the fact that since assets, liabilities, and equity are real accounts, they're going to carry over, their errors will carry over into the next year and affect our cumulative error on these statements. However, the net income is a temporary account, it's a nominal account, and therefore it gets closed out, right? So the error this year doesn't get carried over to the next year, and that's why you will typically see students get this part of it wrong. Even if they get the real accounts right. So looking at this, we already discussed what happened in 2016. You know, you make what happened, what should have happened, and then you total up the effects for that year. Well, in 2016, assets were understated by 60,000 or assets were decreased overall by 60,000 when they should have only been decreased overall by 20,000. So the mistake led to an understatement of 40,000, right? Negative 60,000, negative 20,000 means that we understated by 40,000. Same thing with net income. It was understated by 60,000, or it was decreased by 60,000 when it should have only been decreased by 20,000. Leading to a $40,000 discrepancy between what should have happened and what happened, and that gives me the understatement. And that net income error, when it's closes to equity and creates the same error in this year. Okay, so let's look at what happens in the next year. In the next year, the entries are easy to do. There's no adjusting entry being made because we already accounted for all the rent expense on January 1st, 2015. So there's no entry being made here. So there's no effects going on. In 2016, on what should have happened column, we do want to make another adjustment. We make the adjustment for 20K, just like we did in the prior year. That decreases my net income and also decreases an asset as well. Okay. So when we look at it then, for just 2016, right, just 2016, there's no effect under what happened. And there is a decrease in assets by 20,000, a decrease in net income by 20,000 from the rent expense, and that carries over to equity. Now, we then need to make an cumulative effect of what's going on over both years. So the cumulative effect would be whatever we recorded here, which was the 2015 stuff, and then whatever happened here, which is the 2016 stuff, and then we have our cumulatives here. So in 2015, we had the decrease in assets by 60,000. That would not be closed out. Nothing here. Assets 20,000, down 60,000 just because of this. No effect here. Cumulative is 60. Same thing with equity. Equity's down 60. No effects here in 2016. So that makes equity down 60. Now, what happened to net income? Remember, net income gets closed. It zeroes out. And so even though we decreased net income 60,000 here, when we made our closing entries here, it would go to zero. Nothing happened here with net income, no effects. And so there is no net income error there cumulatively because of the fact that we closed the books. Now, when we look at what should have happened here, right, assets down 20, assets down 20 makes assets down 40. Assets is a real account, so we consider both of these. Right? Same thing with equity. Equity down 20, equity down 20. Well, equity will be down 40. Now, net income, again, is closed here, so it's 0, and then we have an understatement or a decrease of 20. Well, then it's just a decrease of 20 because this is the only year then that would affect the cumulative, since this has been closed out, this has not been closed out, only down 20,000 here. So now to draw what the understatement is, we just look at the difference between these two. Assets are stated $60,000 less. They should have been stated $40,000 less. So the difference between those two is an asset understatement of 20,000. Equity, similarly, is going to be understated 20,000. And again, walk yourself through that logic. Equity is being decreased by 60,000 under what we did. It should only have been decreased by 40,000. So because of what we did, we understated it by 20,000. Now, cumulatively, as of 12/31/16, this is where people start, getting a little bit backwards in their intuition, understandably, but we have no effect in net income as of 12/31/16 under what happened because it was closed out. We have a lingering effect now of 20,000 because of this new entry that we should have made in 2016. And so net income for the year 2016 is going to be overstated by $20,000 if we make this mistake, right? Because we make no entry here. We should have recorded in rent expense at 20,000. Well, that decreases my net income, so it's overstated if I make this error, right? And then you can just translate that up here. Understatement, overstatement, understatement. Again, the accounting equation will work such that assets equals liabilities plus equity. An understatement on assets would lead to this understatement that appeases the accounting equation. The other thing to think about, or the other way you can think about this net income error, well, if equity was understated by 40,000, we then overstate net income. That leads to an understatement of 20,000 because we're going to close this error to the understatement, and that will bring it up. So in essence, if you think of it that way, we have equity that is understated by 40,000. We add to it net income that is overstated by 20,000. An understatement of 40,000 plus something that's overstated by 20,000 would give you an understatement of 20,000 because this overstatement reverses some of the error here. All right. So think about that, ask some questions if you still don't understand it, and we'll talk about it. I'm going to go ahead and move on to the group problems. Again, a lot of which we did in class. The only thing I want to recover on these adjusting entries is this prepaid insurance problem. Remember that the prepaid insurance account was $3,000, and this was an unadjusted 12/31/16 trial balance that you were working with. So that must have meant that these totals were what stood after adjustment on 12/31/15. Now I give you that it was purchased on 7/1/15, and so whatever adjustment we made here would have had to have been for 6 months of insurance cost. So that kind of tells you something here, right? Because we take something we purchased it for, subtract off 6 months of cost, and we get $3,000. Now, I also told you that this $3,000 represented 18 months remaining. And so again, you can divide 3,000 by 18 and multiply it by 12. That gives you the amount that you would want to recognize this year. In that case, then it becomes 1,500. And then after, I'm sorry, not 1,500, it becomes 2,000. And then after adjustments, there is $1,000 remaining as of 12/31/16. And remember, this is the adjusted balance at 12/31/16. This is the unadjusted balance at 12/31/16 or the adjusted balance at 12/31/15. So you have to, I really am playing with that idea of an adjusted versus an unadjusted balance. Right? And then if 3,000 represents 18 months left, there's a lot of ways you can think about it. But if we have a full years of insurance costing 2,000, well then that must have meant we adjusted this thing for 1,000 in the year prior, which brings us up to $4,000 at the date of purchase. Okay. The other way you could think about it is, well, if this 3,000 represents 18 months left, find out the per month, multiply it by 6 to get the amount of the adjustment here, and then work backwards to get your balance. This is why T accounts are so damn important, and you really need to work with them in order to visualize more conceptually difficult problems. Okay. Other than that, I think this one was actually probably more troublesome to a lot of people because of the whole time and adjustments versus unadjustments. This one probably wasn't as bad, the interest payable. Remember, there's two ways of doing it. I think people kind of, they bit into this really fast after they saw the work. And again, just remember when you're calculating tax expense, it's all the revenues adjusted and the ones that you had on the unadjusted trial balance, the ones you introduced with your adjusting entries, minus the expenses, the ones that were on the unadjusted trial balance, plus the ones you made with your adjusting entries. We get a pre-tax number. We apply the tax expense or the tax rate to that pre-tax number to get the tax expense. And then for the retained earnings, I don't ask you for closing entries. So all you need is retained earnings beginning plus net income. And here, notice I just take the pre-tax net income number, subtract off the tax expense, subtract off dividends, and that gives me ending retained earnings. Okay, number 2 is another one of these adjusting entry errors. And that's, these adjusting entry errors I think are interesting problems. Because they really force you to think about the process. Now, this adjusting entry error happens with equipment expense and cash. They recorded the purchase of equipment as an expense, which we know is incorrect. We want to debit the asset account and credit the cash account. So what we get as facts are that the equipment was determined to have a useful life of 5 years. I give you a salvage value here. This is an older problem that I updated, so I usually won't use salvage values anymore. They just make unnecessary, silly complications. So they purchased it on January 1st, 2016. We have to have the errors for these 2 years, assuming that this is what happened. Well, we know that's not what's supposed to happen. We should have had the purchase of an asset recorded, and then depreciation expense and accumulated depreciation per the matching principle. So looking at what happened versus what should have happened, I format this one a little bit differently, just kind of putting the errors together down here. But what happened, right, we had that entry, we brought net income down and assets down with this entry. What should have happened, we should have recorded some equipment, we should have credited cash. That is an increase of an asset for a decrease of an asset, so assets net each other here. At the end of the year, I didn't put it over here, but yeah, there would be no entry because the only reason to record depreciation expense is to start to match this, expense of the machinery over time. They did it all at once. So we calculate depreciation expense. It's the historical cost less the salvage value divided by the useful years, gives me 90,000. I then adjust the depreciation expense by 90,000, accumulated depreciation by 90,000, a decrease in net income. And since we are increasing accumulated depreciation, we're increasing a contra asset, and that reduces my assets overall. Okay, so make sure you understand we're increasing a contra asset. This is not a liability, and that decreases my assets overall. So then the errors for as of 12/31/16, well, we have an overall decrease in assets by $500 from what happened, just the cash. We also have a decrease in net income by $500,000, which translates over after we close it to an equity mistake of 500,000 too, or in this case, just a downward influence on equity. And then in what should have happened, right, the assets net out here. So this is basically zero in terms of its overall effect. Then we just have this $90,000 decrease to assets from accumulated depreciation, and then a $90,000 decrease to net income from the depreciation expense translates over to the equity. Now, again, just ask yourself, assets were decreased by 500. They should have only been decreased by 90. So that means that we've understated, right? Understated our assets by $410,000. Same thing with net income. We decreased it by 500. We should have only decreased it 90. So we've understated our net income by 410,000. And then that translates to equity. We decreased it by 500, decreased it by 90, an understatement of 410,000 because we decreased it by 500 rather than 90. No effect to liability still because there's no liability accounts in play. Now let's look at 2017. Again, this gets a little trickier. You want to accumulate all of the errors and make sure that you only consider net income errors for 2017. So accumulate the real accounts, only consider net income for 2017. Assets, there was no effect in 2017, so they're still going to be decreased by 500 from the original transaction. Equity, similarly, no effect here. Net income was closed out in 2016. That expense would have been closed out in 2016. And it continues in equity because equity is a real account. In 2017, now we do, under what should have happened, record more depreciation expense, more accumulated depreciation. So we have a decrease in assets by 90,000. That leads to an overall, at this point in time, of 180 last year plus this year's entry. In net income, remember, we don't accumulate it. We had 90,000 in the prior year, but that was closed out. So net income's at zero. We only decreased net income by 90,000 this year. And then equity, this 90,000 was closed out to equity, right? Puts it there. We have another 90,000. That also gets closed out to equity. So now it's down by 180. So again, a lot of people will get this part right where they say, okay, assets are down 500. They should only be down 180. That's a discrepancy of 320. And if I do this, then I've understated it by 320. No effect of liabilities. Equity, similarly, we have it was put down 500,000 by what happened. It should only be down by 180. So we've understated it 320, the difference between these two amounts. Now, the income in this year is decreased by 90. What we did was nothing, right? There was no entry to net income this year. There was no depreciation expense recorded under what happened. And so if we make this mistake, then we actually overstate net income by 90,000. Because it should have depreciation expense of 90,000, but that 90,000 is not recorded. And again, a way you can think of it is you're reconciling this equity from this to that number, right? So from this transaction alone, again, you have an understatement in equity by 410. You add to that an overstatement in net income by 90,000, then the result is going to be an understatement of 320,000. Now, another way to think about these mistakes, and it helps in a later chapter, is to think, right, well, if it's understated, that means that it's the true value X minus 410. If this is an overstatement, then it's the true value Y minus 90, because these are two different things, right? Equity should be at X, net income should be at Y. And then when you add them together, what you get is X plus Y minus 320. So that's where the 320 comes from. That's why the errors balance themselves out that way. Okay. Number 3 is another very interesting problem. It really forces you, once again, to use your adjusting entries. Now, one thing I noticed when updating this problem, I should have, it could confuse you. It doesn't throw off the numbers any, but this salaries and wage expense would more appropriately be stated at 3,200, and we'll see why in a second. But so I give you an adjusted trial balance. Now, again, I'm twisting this all around on you to make you think about it. If this is an adjusted trial balance, then we've already made adjustments to these accounts. They are the adjusted balances as of the end of January. Before I was giving you unadjusted trial balances. So be very clear about whether you have an adjusted or an unadjusted. I said that the nominal accounts were last closed on December 31st, 2015, so that you know that these expenses all accrued during the month, and that's why this becomes important on Part C. Right? So Chris closed its nominal accounts on December 31st. Let's look at Part A. $1,000 of supplies were purchased in January. What was the balance in the supplies account on December 31st, 2015? So I'm getting you to work backwards. If you think about it in a T account, we have a $900 debit balance after adjustments. So that's what the account is at January 31st, 2016. Now, where do I get the rest of these numbers? I tell you that we purchased $1,000 of supplies. Well, that would be a debit to supplies, a credit to cash or some other account. But we know that we would increase this account by $1,000 if they're purchased. And the $850 comes from the supplies expense that is recognized during the month. Remember, they would have been closed out. There would have been zero at the beginning of January. So we must have credited the supplies account whenever we recognize supplies expense as an adjusting entry, and that makes the $850. Remember, this is the adjusted trial balance. This is something that happened at the end of January to give us this account balance. Once you have those two balances, you can work backwards in order to get that. It must have been $750 of supplies on December 31st, 2015. For number two, B, $400 was recorded as a monthly allotment of the original insurance premium in accordance with the matching principle. When will this contract expire? So we have the $400 expense that was recorded during the month. That's good. This is the amount that's remaining, $2,400. So we take that and we say, well, if I've already adjusted it, that means that this represents February and onward, because I've already taken out January's expense, since this is, again, an adjusted balance. Well, you take the $2,400 that's remaining, divided by 400, that gives you the 6-month time period that's remaining. And again, because this is an adjusted trial balance, it's 6 months from the end of January. And again, count on your fingers just to be careful. All of February, all of March, all of April, all of May, all of June, all of July. So that means July 31st, 2016 is the expiration date. Finally, C. This is the one that I made a typo, and that it really should be 3,200. The idea is that we have $2,700 of supplies and wages being paid during January. I say that workers accrued additional pay of $3,200 during the month. What was the balance in the supplies and wages payable account? Now, this is very similar to A, in that you want to set up a journal entry. You want to get this idea that we're dealing with an adjusted trial balance. So whatever the balance of this supplies and wages payable account is the adjusted balance of the item. We're trying to figure out what the beginning balance is, i.e. that is what it was on December 31st, 2015. I say that you paid $2,700 during January. Well, if we paid them off, right, that would be a debit to wages payable and a credit to cash. So $2,700, credit cash, $2,700. And then I say that we accrued additional pay of $3,200 during the month. And so if we accrued that much more, it would be wage expense by $3,200, wages payable by $3,200, credit. Well, that tells you what you put in the wages payable account as a credit. And then again, you just reconcile the balance of this account so that you have X plus $3,200 because it's a credit balance, minus 2,700 equals 800, solve for X, and that gives you the balance of the supplies payable, not the supplies, sorry, the salaries payable account. Okay. So I find those ones interesting and very, very much an exercise of critical thinking. Those are tough, and I don't expect everyone to be able to do them, and I expect my upper Bs and my As to be able to do them. The missing cash balance. This one is a fun one just because there's two ways you can do it. One way is a lot longer than the other. You could use the accounting equation. It'll work out just the same. The best way, I think, is to use a trial balance, because once you just lay all these out in their trial balance state, right, then you just have to add all the credits. You have a $397,000 credit balance. Then you see that your debits add up except for cash to $387,000. So therefore cash must have been $10,000. And then the closing entry problem isn't too tough of a problem, probably a C plus, B minus problem. The income summary has a debit balance of $32,500. The company also pays dividends of $10,000. If they had retained earnings of $150,000, then what is the end of year retained earnings? Well, I would just go ahead and write the balances out in T accounts so that you see what's going on. We don't know what happened here. We know we just have this $32,500. We do know that dividends is a nominal account. It would start at a zero balance. We pay dividends or declared them of $10,000 and paid them. So we have this $10,000 balance here. You just make the closing entries, debit retained earnings, and credit the income summary. That's a little different, right? That's what will throw some people off here, is that in order to close this account, we really have to credit it. So this is actually, remember, if there's a debit balance here, it's a net loss. And so it's decreasing retained earnings, which we expect. We do the same thing with dividends, credit it to zero it out. And then that results in a debit to retained earnings. And then we have the retained earnings. Again, use T accounts, because I find that one of the most important things here is to understand how, well, I credit this, which puts that credit there, which makes this zero. I credit this in a journal entry first. That moves to the ledger, which makes this zero. And then this debit here puts that $32,000 there, that $10,000 here puts it there. It's always very important to understand the flow of information and how inputs go into the accounting process. All right, so that is the extent of the problems there. Make sure you go over this. Make sure you understand it. If you have any questions, please email me or bring it up during class. Thank you.